Thanks so much for joining us. I really appreciate it. I hope you're enjoying the day. There's been a lot of great talks. I'm grateful to be here with Fred to discuss the mining industry with you. So to kick things off, Fred, on April 19th, the Bitcoin halving occurred, and Bitcoins produced by the network dropped from 900 a day to 450 a day. Could you talk a little bit about the implications of miners with this, how Marathon prepares for this, and then also what is your outlook over the next 12 to 18 months?
Sure. So it's a planned event. It's not like this black swan event that happens all of a sudden. So it's something we know about and we plan for. And so many miners over the last 12, 18 months were focusing on what were they going to do to deal with the particular conditions of their business and how they were mining as a way to take care of what was happening. And if you go back 12 months ago, or a little bit further than that, Bitcoin price wasn't exactly in a place where having a halving was going to be a positive event. Thankfully, Bitcoin price kept moving up, and so miners became more bullish, bought more equipment, started trying to mine as much as they could before the halving. And essentially, you focus on optimizing your capacity and trying to lower your cost to mine as much as possible. And with Bitcoin price where it is today, the vast majority of the industrial scale miners, or what we call utility scale miners, can still operate profitably, and so you haven't seen this big drop in hash rate that you would have seen. But if Bitcoin were to drop sub 50,000, it would create some pain for some miners. And you had a lot of people upgrading equipment over the last year, replacing inefficient machines with much more efficient machines. And by way of example, the machines that people were installing 3 years ago, S19 kind of J Pros, had an energy efficiency of about 30 joules or 30 watts per terahash, and terahash being a unit of compute, kind of like horsepower, if you would. The latest state-of-the-art machines that people have been installing this year have been closer to either 17 watts or joules per terahash to 20, so almost a 50% reduction in the amount of energy you use. Well, if you think about a data center and you're paying for, let's say, 1 megawatt of power, well, if you're replacing machines with new machines that are now upwards of 50% more efficient, in other words, you get almost twice the horsepower for the same amount of energy use. That's what causes global hash rate to grow, leading into the halving. And so you had a lot of growth, a lot of replacement, more efficient machines, and now the overall efficiency of the mining fleet globally is considerably lower than it was at this time last year, and that's helped out. So it's a combination of vertical integration, lowering your costs, putting in place more efficient machines. And we're one of the only industries in the world where every 4 years we have to figure out how to be more efficient, regardless of the price of Bitcoin, just because our revenue from a unit of commodity perspective, Bitcoins, is going to be halved. And so if the price of Bitcoin doesn't go up, we have to lower our cost to operate continually. And it makes this industry very, very effective at lowering its energy consumption. And it's something that gets lost in conversations about Bitcoin mining and its energy use. And that is that every 4 years, we have to get super efficient. And we have continued to do that. And I think the best miners in the world will continue to do that. And we're here for the long run to mine Bitcoin and secure the Bitcoin network.
So we just saw the Bitcoin halving take place. Historically, if you look at digital assets, the 12 to 18 months post-Bitcoin halving window is usually the best time to be exposed to the space. What's your outlook? What do you think is going to happen in the next coming year?
So I think this cycle is a little bit different than prior cycles, mostly because of the ETFs. So historically, as you said, typically there's a period 6 months after the Bitcoin halving where Bitcoin price may even drop. And then you have this initial peak, typically almost sort of 6 to 9 months post-halving where you would equal the prior all-time high. And then there'll be a dip again, and then 12 months later you have another peak, and at this point it's typically 2x the prior all-time high. What happened with the ETF is you essentially pulled a lot of pent-up demand that would normally have come post-halving into the pre-halving period as these ETFs just sucked in all sorts of capital from predominantly retail. Now we're starting to see more and more institutional buyers buying into the ETFs. A number of the large banks, some sovereign wealth funds, some governments have bought into the ETFs. And so you're starting, that demand kind of ran the price up. And so that's why you've seen this choppy period now. And I think most people expect this cycle to kind of not have the same volatility levels that traditional cycles have had. And if you look at the historical charts, Bitcoin volatility has been decreasing. And with 70+% of all Bitcoin held in long-term wallets, excuse me, that haven't moved in 6 months or more, liquidity is shrinking on exchanges. There's almost barely 2 million Bitcoin available on exchanges. That's essentially 10% of the supply. And as that continues to decline, it makes it harder for people to accumulate Bitcoin, which will create spikes of volatility. The other thing that the ETFs have done is they've changed the nature of how Bitcoin trades. ETFs settled T+2. So if you buy an ETF share on Monday, they don't actually, on Friday, they actually won't go buy Bitcoin until Tuesday, sometimes Monday. Now we're moving to T+1, and so we'll see that change a little bit, but it still provides an opportunity for weird price movements on weekends and things like that. So I think the market continues to evolve, but essentially this cycle, I think we've seen some pull forward of the appreciation. But longer term, I think people are getting more and more bullish on Bitcoin because it's a finite supply. We're at 19.7 million Bitcoin mined to date. Circulating supply is a fraction of that. Exchanges have limited liquidity. And I think as time goes on, as more and more companies, more sovereigns put this on the balance sheet, it's not going to move from a liquidity perspective, which means you're going to have less and less Bitcoin available to buy. And there's an interesting statistic. There are today already not enough Bitcoin in the world for every millionaire to own one Bitcoin. Right? Think about that. If you're a millionaire, the likelihood that you can own a Bitcoin is fairly low because there are only 19.8 million Bitcoin available, and there are 48 million millionaires out there. So this is going to get to a place where we stop talking about Bitcoin and we're talking Satoshis. So it's an exciting time.
I always do my best to try to price things in BTC whenever I'm looking at things as opposed to dollars because it helps me with a better unit of account for the long term.
It's funny. You have this big Mac index for prices around the world to gauge how expensive a city is to live in. And if you look at the Bitcoin index, things have gotten cheaper and cheaper.
Very, very cheap. Price everything in Bitcoin. Things are looking good. So you noted before around the halving how you have to become more efficient because the revenues are going to get cut. We're seeing new innovations built on top of Bitcoin with things such as ordinals, which are NFTs, or the most recent, which is runes, which is a new non-fungible token protocol standard. And I'd love to learn from your perspective, how is this impacting the miners and what are the implications of this long term?
Yeah, so if you think about how the Bitcoin software was originally conceptualized by Satoshi, you have essentially a mining incentive, which is the block reward that miners get, which should decrease over time as adoption increases and transaction fees increase. And so that's why you have the halving. You have supply, this emission from the network automatically that is an incentive to miners to mine and invest in the energy in the miners that we do. That decreases every 4 years, and the intention was that, or the plan was that transaction fees would eventually mitigate that decrease and would still provide an incentive to miners to continue to operate their systems. Ordinals and BRC20 tokens, last year there was a period in May and a period towards the end of the year where in some cases the transaction fees associated with blocks went from 0.3 Bitcoin, which was kind of the average, 0.1, 0.3 Bitcoin, something like that, to 7, 8 Bitcoin per block. Now this is when the block subsidy was 6.25. So if you think about a world where today the block subsidy is 3 1/8 Bitcoin, I'm old school, so I use fractions. If the block reward could be 6 Bitcoin, what effect does a halving have? Kind of de minimis. So over time, we're going to continue to see these transaction fees increase. And there's a desire from people to be able to prioritize transactions. And it's not because they're trying to front run things. It's simply they have just done a trade and they don't want the value of that trade to change just because the mempool is backed up. And so there are services like the one we have launched called Slipstream, which allows you to reserve block space in advance. So it's kind of like a charter travel company reserves seats on airplanes. We provide a service, an API, that companies, primarily financial institutions, can reserve block space, but it can be used for reserving block space for ordinals or anything else. But that gives you the ability to essentially guarantee execution of a trade, confirmation of a trade within a certain period of time, and it increases the fees of that block. And so you can see in the mempool, if you look at it, the fees earned by various pools, the pools that do this type of service, like Marathon's Marapool, earn fees at a higher rate than average because we're optimizing the value of every block.
Gotcha. Very interesting. Another thing we're starting to see, and the major buzzword that's coming out like crazy, is AI with everything. I don't know if you saw the Microsoft keynote the other day. They said AI like 100 times throughout the keynote. It was pretty funny. But we're starting to see a trend with miners looking for opportunities to build out AI infrastructure for compute. So larger technology organizations, if you're going to have exponential growth for the computing processing that's going to need to happen in that space. And one of the ways to go about it is looking at people to leverage existing infrastructure or build new infrastructure for that. I'd love to hear your thoughts around how the Bitcoin miners are thinking about this and where the market opportunity could be.
Yeah, so if you think about AI and the rigs that AI LLMs need and inference needs, those H100s, as they're called from NVIDIA, for example, you can't put a lot of them into a traditional data center, and that's because the power density in racks in traditional compute data centers, like what AWS has or Amazon, Google or others have, just isn't dimensioned properly for it. And so you need to go to higher power densities. And that's a similarity that Bitcoin mining and AI have. And that's where it ends. Because the minute the electrons come out of the wall, AI systems need to have guaranteed uptime. You can't just shut them down to curtail like you can Bitcoin miners. And they need very expensive infrastructure. And the infrastructure to build an AI data center is easily 10 to 15 times greater than that to build a Bitcoin data center. And it's not like you can build a Bitcoin data center and convert it into an AI data center. You basically have to scrape and start over. The only benefit you have is you have access to power at a particular price. The other challenge is, in the AI world, you need access to high bandwidth internet. And so if you think about Bitcoin miners, what do? They buy stranded power. They're buyers of last resort of electrons. And they don't need an internet connection because they can use Starlinks if they need it. So there's not a very good overlap, but it makes for a great story to sell to investors. But you are competing as a Bitcoin miner against Amazon and against Microsoft and against Google for power and energy, and they're willing to pay a lot more. And I'll just give you an example of a data center. So Microsoft is building a data center for AI. They're spending $800 million to build a 3-story building. You have to do it vertically because all of these GPUs have to have very high-speed connections, network connections, because every core has to talk to every core. And that's a fiber optic system. And distance is critical. And so they build it like you're building a ball within a building, right? $800 million for the building, $3.2 billion for the infrastructure. I could build a Bitcoin mining site using the same amount of power for a total of $100 million in that site. That's the difference. I think we're just way early in the hype cycle, but we are seeing a definite convergence between the energy industry and compute that we will continue to see, and I think you'll see Bitcoin miners moving more and more towards the edge. And the AI guys taking core power around, nuclear power plants, large 24/7 availability of power that's clean, and then high-speed internet connections. But you're seeing states like Virginia putting essentially moratoriums on data centers. And, the state of Georgia has said that they underestimated their power needs by 40%. And this is the energy industry, if you think about it, in the US for the past 20 years, electrical demand has increased at an average of only 2% a year. And now they're forecasting it to change to closer to 20%. Wow. You can't build infrastructure fast enough. You can't build transmission capacity. So it's going to be very interesting.
You brought up an interesting point around power. So Bitcoin miners and AI companies are competing over the same thing, which is power. And from a policy perspective, we often see these get looped in together, but they shouldn't be. So from your perspective, what is the reason they should not be looped in together, and what is the risk of doing so?
A couple of things. For one thing, Bitcoin miners act as grid stabilizers because of our ability to curtail. So we can go into a region where you have large blocks of renewable energy, solar and wind, which is intermittent. You can't guarantee that a cloud won't come in front of the solar panels or that the wind will be blowing. And so grids, like in Texas, have to have a balance of baseload energy generation, which is nuclear, coal, natural gas, typically, and then this intermittent supply, which is renewable. And when the renewable supply drops because it's cloudy or rainy or there's storms or there's no wind, then they have to turn on more capacity. Well, they typically do that using peaker plants, which are natural gas fired. It's like a jet engine. You turn it on. And yeah, if electricity is $5,000 a megawatt, you can make money with that. Bitcoin miners consume large amounts of baseload energy. They're using this energy on a daily basis. But when the grid needs it, they can shut it off in 10 minutes. And that doesn't cause an incremental cost to the consumer. Peaker plants do. AI doesn't have that capability. It needs to run 24/7 or some consistency with maintenance shutdowns, but it needs to run basically, because if you interrupt a model in the middle of what it's doing, you then have to restart the process. More importantly, if you're running AI inference, it's kind of like, would you shut down Netflix for power purposes? How would the consumer experience be if you're watching your latest favorite show on Netflix and, oh, sorry, due to power curtailment, you're going to have to wait 30 minutes before you can watch the rest of this. So, they're very different use cases for the power from a perspective of the quantity that's needed is similar, but the quality of power and the uptime is very different. And so, with AI data centers, you also have to look at how are they cooling the data center. Microsoft has gotten dinged heavily because of the water that they consume to cool their data centers. Bitcoin miners like ourselves, we do immersion cooling in oil, a special type of oil. It's a closed loop process. We're not using water for what we do. So you have to really look at the implications. The other thing that Bitcoin miners do very well that AI doesn't do is because our infrastructure is less expensive, we can go into a solar farm or a wind farm where they're only able to sell electricity a few hours a day, a few days a week, a few weeks of the year, and that's how they have to make their profits back. And we can sit and consume all the excess energy they have because we can be a baseload customer. And so we make renewable energy projects viable, which is not something AI can do, because AI can't run on solar or wind. They have to have a 24/7 load. They can use some solar and wind, but they have to complement it with grid energy.
And so the Bitcoin mining industry has done a ton in advancing renewable energy opportunities, and they're always pushing the envelope. In closing, I'd love to learn, from your perspective, Marathon, you've been a leader in this, so what are you doing in the renewable space, and what are you excited about what's coming down the pipeline?
Yeah, so we recently announced a reorganization into business units of our business. So our traditional utility scale mining business are these large mining sites that we run. We have 11 sites on 3 continents around the world. We mine in North America, South America, and the Gulf region, and soon to be Africa and other places. There we're taking large-scale power and balancing the grid. We recently started a division that we call energy harvesting, and this is where we're taking true stranded energy. This is energy that otherwise can't be used, like methane coming off of landfills, flare gas from oil fields, biomass that is a byproduct, essentially, of food processing, alcohol production, methanol production, things like that. This is agricultural waste, essentially, that has to be processed before it can be used as fertilizer or other things. We take this stranded energy and we create electricity, and then we use our mining equipment to generate heat, capture that heat, and then we sell the heat back into the industrial process. So we co-locate very small mining farms, essentially, adjacent to industries that have a biomass or a byproduct that is something that is bad for the environment that needs to be mitigated, so flare gas in oil fields, generate electricity from that, and then we feed heat back into whatever their process is. And it's interesting to note that 50% of industrial energy use across energy types is for heating something. And of that, about 14% is low-grade industrial heat, sub 50 degrees centigrade. And our systems in immersion capture and output fluid if through the heat exchanger you can pump water through it, for example, at 50 degrees C. So we can heat buildings, we can preheat fermentation systems, all sorts of things. And essentially the model here is that we're generating energy from true wasted sources, and we're mining Bitcoin at zero cost because we're paid to take the material and we're paid for the heat. And at that point, the Bitcoin mining is just how we generate heat. And so I fully expect to see millions and millions of very decentralized Bitcoin mining sites attached to industrial processes and even communities over the future, which will ensure the decentralization of the Bitcoin network, ensure the security budget, because if you're not paying for energy, it doesn't matter what the price of Bitcoin is, because that's not the business you're in. You're now an energy company. And so that's why we start talking about, instead of saying Bitcoin mining, we're in the business of digital asset compute, because we're providing compute. But more importantly, we're becoming an energy company as well.
That's great. Well, I really, really appreciate you sharing your insights and joining us today. And thank you, everybody in the audience, for joining us. Hopefully it was valuable to you. And I want to thank the Digital Chamber for all the hard work that they're doing in the digital asset universe to advance policy and help on the regulatory front so we can continue to build this industry. Thanks so much, everybody. Take care.
Thank you.
All right,
thank you. Appreciate it.